All right, let's talk Alcoa. They just dropped their Q3 earnings and, well, the market did not like what it saw. We're here on Talk Tickers to break down what's going on, why investors are so spooked, and what the company's next move might be. Let's dive in. Okay, so let's get right to the punchline. Boom, down over 4% in after-hours trading. That's the market's immediate gut reaction, and it tells you pretty much everything you need to know. It's a thumbs down. So the question is, why? What was in that report that caused such a quick sell-off? So what happened here? Well, it really comes down to the headline numbers. This was a classic miss, and not just on one metric, but on both the top and the bottom lines. And, when you miss on both, it's a tough look. Let's put some numbers to it. As you can see, revenue came in at $3 billion, but Wall Street was looking for a little more, about $130 million more. That's a miss for sure. But the real story, the part that probably made people gasp, was the earnings. The adjusted EPS, that's the number everyone really watches. It came in as a loss of 2 cents per share. The street was expecting a profit of 2 cents. So that 4-cent swing from profit to loss, that's what gets headlines and that's what moves stocks. But this is where it gets kind of wild. If you look at the official, by-the-book GAAP number, they actually made 88 cents a share. So wait a minute. How do you go from a positive 88 cents to a negative 2 cents? That's a huge gap, right? It's almost a full dollar per share. And what that tells you is that there is a ton of noise in these numbers. Some really big one-off things are happening behind the scenes. And here they are. This is what's causing that huge swing. On one hand, they had massive gains. We're talking over $1 billion from things like selling off a piece of a joint venture. That's your positive 88 cents. But then, bam, they got hit with a nearly $900 million charge for shutting down their Kwinana refinery. So you've got this giant gain coming in and a giant loss going out. It's like they're doing a massive spring cleaning of their business, and all these moves are totally obscuring what's actually going on with their day-to-day operations. So, naturally, management got on the earnings call and basically said, hey, don't look at that messy adjusted number. Their whole focus was on operational stability and portfolio optimization. In plain English, they're telling investors, look past all this one-time accounting stuff, focus on the strategic moves we're making for the long haul. And you know what? They actually made a pretty decent case for themselves. They pointed out that production is actually up for both alumina and aluminum. They're even setting records at some of their smelters. And they're making moves for the future, too, like getting closer to a really important long-term energy deal in New York, and even looking into a new plant for gallium in Australia, which is a super critical material right now. So the core business, they argue, is pretty solid. Okay, so that's the story of this quarter. But what about next quarter? What's the outlook? Well, this is where it gets complicated again. The guidance for Q4 is, well, it's a real tug of war. There are some really good things happening, but they're being pulled back by some pretty significant bad things. And this chart just lays it out perfectly. Look at this. They're expecting a big $80 million tailwind from their Alumina segment. That's awesome. But, and this is a big but, it's almost completely wiped out by headwinds in the aluminum business. We're talking a $20 million hit there, plus another $50 million hit from tariff costs. So you've got plus 80 and minus 70. It's almost a complete wash. That's the tug of war I'm talking about. So let's get to our final read. The big takeaway from all this. What does this actually mean for the stock? You've got a really messy present, but management is painting a picture of a much cleaner, more streamlined future. So where do we land? So after a quarter this messy, with guidance that's all over the place, what is the call on AA? I mean, do you side with the market, which is clearly hung up on the miss? Or do you buy into management's story about strategic wins? How should we be thinking about this? All right, here's our call at Talk Tickers. We're rating Alcoa a market perform. What does that mean? Basically, we think the stock is probably going to perform in line with the broader market. The good and the bad, they kind of cancel each other out for now. And here's why we landed there. Look, on the plus side, we absolutely get what management's doing. They're cleaning up the business, and the underlying operations seem pretty stable. That's good stuff, but you just can't ignore the negatives. These tariff headwinds are real, and they're going to hurt profits in the short term. And the truth is, the stock is already lagging its competitors. For it to really take off, something big and positive has to happen. It needs a catalyst to change the story. Now for our trade idea, and this one is a bit more on the spicy side. We're calling it the outrageous but plausible trade. The idea is to buy call options for the next earnings cycle. Here's the bet. You're betting that the market is focusing too much on these temporary tariff problems. If management can execute cleanly, and especially if they land one of those big catalysts like that Massena energy deal, you could see the stock get re-rated in a hurry. The tariff overhang gets priced out, and boom, the stock could really move.
And as always, remember, this is not financial advice.